Elon Musk's SpaceX just pulled off the biggest IPO in history and then lost over $600 billion in value in less than 2 weeks. If you bought in during the hype, you might already be underwater. Here's exactly what happened, why it happened, and what you actually need to watch next. What's up, everyone? Welcome back to the channel. Today we're breaking down the wild ride that is SpaceX stock, ticker SPCX. This is one of the most talked about IPOs of the decade, and honestly, the last 2 weeks have been a masterclass in market volatility. Let's get into it. So here's the setup. SpaceX went public on June 12th, pricing shares at $135. That alone made it the largest IPO ever recorded, raising close to $86 billion once the underwriters exercised their extra allotment option. And the stock didn't just pop, it went vertical. Shares opened at $150 and within days rocketed up 67% to an all-time high of $225.64. At its peak, SpaceX's market cap brushed up against $3 trillion, briefly passing both Amazon and Microsoft to become one of the most valuable public companies on the planet. Elon Musk, by the way, became the world's first trillionaire off the back of this. That's the euphoria phase. Now here's where it gets messy. Starting just days after that peak, the stock reversed hard. 3 straight losing sessions wiped out roughly $600 billion in market value. On the worst single day, shares plunged nearly 17%, the stock's biggest one-day drop since going public. By the following Tuesday, SpaceX shares had fallen all the way back below their opening price, down to about $147, meaning anyone who bought in on day one was sitting on a loss. That's an 11-day round trip from euphoria to nearly break even, or worse. So what actually triggered the sell-off? A few things stacked on top of each other. First, SpaceX confirmed it's preparing a bond offering of at least $20 billion, its first-ever investment-grade debt raise, aimed at refinancing a bridge loan connected to its acquisition of SI. Big debt announcements make investors nervous, especially for a company already burning significant cash. Second, rising Treasury yields hit high valuation tech stocks across the board, and SpaceX was trading north of 100 times trailing earnings, which left very little room for error. Third, this coincided with a broader tech sell-off driven by fears around an AI valuation bubble dragging down chip makers and AI-adjacent names right alongside SpaceX. Now here's the part every investor should really pay attention to. Analysts are deeply divided on what this stock is actually worth. Morningstar slashed its fair value estimate down to just $62 a share, less than half the current trading price. NYU valuation professor Aswat Damodaran came in around $1.3 trillion for the whole company, roughly 26% below the IPO's implied valuation, and he publicly called SpaceX's massive total addressable market projection unrealistic. On the flip side, some fund managers see this volatility as a buying opportunity. Cathie Wood's ARK Invest actually added shares during the June 22nd dip. And some portfolio managers argue that with SpaceX's revenue growing and new AI compute deals, like partnerships with Google and an AI startup called Reflection AI, the fundamentals are improving even as the stock price swings around. Here's the risk factor that could matter more than anything else in the coming months: lock-up expirations. Right now, SpaceX's public float, meaning the shares actually available to trade, is only around 4% of the company. But there are scheduled unlocks coming, including one tied to the company's upcoming earnings report and others through late August and September. Estimates suggest insiders could potentially sell enough shares to increase the float by roughly 900% by early September. When that many new shares hit the market at once, it can create serious downward pressure, regardless of how the business is actually performing. So if you're holding this stock or thinking about buying in, here's what's actually on the calendar. 1. SpaceX's first earnings report as a public company, expected late July or early August. That's the first real data point on whether revenue can justify this valuation. 2. The lockup expirations rolling through August and September, which could flood the market with new shares. 3. The broader macro picture, interest rates and the ongoing debate about whether AI valuations across the market are overextended. This is a young stock with a tiny float, huge hype, and a lot of moving parts. That combination means big swings in both directions are going to keep happening. This isn't financial advice, just a breakdown of what's actually happening so you can make your own call. If you found this useful, drop a like, subscribe for more market breakdowns, and let me know in the comments, are you buying this dip or staying far away? See you in the next one.